Hey, what's up you guys? In this video, we're gonna go and expose what the banks aren't telling you about getting a new loan or a mortgage, and we're gonna go and talk about the truth of mortgage rates. Hey, what's going on everyone? This is Sam Kwak, one of the Kwak Brothers, real estate investor and entrepreneur. And this video, we're gonna go and expose some truth about the things that the banks aren't telling you, as well as mortgage rates, how they can be dangerous if you don't know this one concept. Now, before I dive right in, be sure to hit the subscribe button as well as the bell notification button so that you get notified for our future videos. Let's go and dive right into your mortgage rate. Now, chances are you might be looking to buy a new house or you're looking to refinance because your mortgage broker or your banker may say, well, hey, Mr. or Mrs. Borrower, we got a cheaper rate for you. We can save you money. Come back in and we'll go and refinance your loan. Well, before you do that, before you say yes, I want you guys to pay attention to what the banks aren't telling you, and I'm gonna go and share what that is. So first of all, let's go and talk about the mortgage rate. And a lot of times when you go and refinance or get a new loan when purchasing a new house, your interest rate is going to be anywhere between 3 to 5% interest. Now, some of you guys may have less, because your credit score is amazing or you have good financials. But a lot of times I look at interest rates, they're going to be anywhere between 3% to 5% interest, depending on your credit score and varying financial factors. Now, 3 to 5% interest rate may not seem that dangerous or it may seem very small, and you're like, hey, 3 to 5% interest rate doesn't seem like a whole lot. And you may argue and say, Sam, 3 to 5% interest rate, the interest rate that we are seeing right now historically is very, very low. It's true. If you go back and look at 1980s and 1970s interest rates, they were as high as 18%, 17% interest rate, which is crazy, right? But we look at the 3 to 5% interest rate, and I'm going to tell you guys why this is equally dangerous as 17% or 18% interest rate because of the amortization period. And this is what the banks don't really talk about, is the amortization period. A lot of people go in and assume that they're going to get a 30-year amortized loan. And vast majority of Americans today get a 30-year amortized loan. And I'm going to show you guys why the 30-year amortization loan plus the 3 to 5% interest rate really doesn't mix well together, especially if you're looking to save money on interest. So let's look at the 3% scenario. Let's say you did go down the bank and got a 3% interest loan, okay, on, let's say, a $250,000 loan. Okay, $250,000 loan, 3% interest rate, and 30-year amortization. Now, I know some of you guys may have more than $250,000 of loan that you need to go get, or you can have less, right? I'm just putting out what's average in terms of the nationwide numbers. So if you look at a 3% interest rate on a $250,000 loan, I'm going to go and put this on the screen. Notice not the interest rate, but I want you guys to pay attention to the accrued interest that you have to pay by the end of 30 years. You can see that you're paying a fairly large chunk of money in terms of interest. So that 3% interest loan, okay, it may have seemed innocent, right? It may seem like it's not going to hurt anybody, but you can see here already you're going to end up paying a good chunk of money for the interest. Whenever you guys go and talk to a banker or a mortgage lender, I want you guys to pay attention to what is the accrued interest amount. That's something that the bankers are not going to want to talk about, because as soon as they know that you know what the interest amount is going to be, they know you're going to freak out. So they don't want you to pay attention to the accrued interest amount. They only want you to talk about, or at least look at, the interest rate, because they know just by looking at that 3% interest rate, you're like, it's not too bad. I'm just going to go for this anyways. Now, let's say worst case scenario, you get a 5% interest rate or greater. And I'm going to talk about 5% interest rate because there's a significance with that 5% interest rate loan. So let's say you went and got a 5% interest loan on the same figure, $250,000, okay? For 30-year amortization. I'm going to put this up on the screen. You'll notice that you're going to actually pay close to the double the amount that you initially borrowed from the bank. Meaning, if you borrow $250,000 at 5% interest for 30-year amortization, you're going to go and pay close to $250,000 just in interest alone, which means your total payment is going to come close to $500,000. So what you just did is you bought yourself a house, and you also bought your bank another house that's an equal value or close to the equal value. A lot of people, when they don't pay attention to the accrued interest amount, they just go for the 5% interest rate because they think, well, this is historically low, it's not too bad, I'm just going to go and pull the trigger. But I want you guys to pay attention to what is the accrued interest amount. Again, it's not necessarily about the interest rate. It's about how much you're actually going to pay by the time you're done paying off the loan. So I know some of you guys looking at this, I'm like, oh my gosh, like that 5% interest loan, it's not as innocent as I previously thought, right? Gives you guys a second sort of consideration as to why getting a 30-year mortgage or 30-year amortized loan may not be the best idea. The next thing that the banks don't really talk about is the amortization chart. This is what's called an amortization chart. And on the bottom, you got time, and we're going to express this in years, 30 years, and this is 0. And on top, the vertical line is the amount of monthly payment every month on that mortgage. So let's assume that your mortgage payment is about, let's say $1,000. I know some of you guys pay more, some of you guys pay less. And I'm going to change the color up here, okay? All right. This line here, I'm going to draw a little bit better of a curve. There you go. This line right here represents the interest. So red is interest. And I'm going to change my color again. This blue line represents principal. Now, principal is what we actually want to pay off. That's the actual loan amount that we're seeking to pay off to build equity, to build wealth on your home. Now, you can see here, right around here, okay, at this point, you're picking up more equity, right? You're picking up more, you're paying off more of your balance. Now, what I want you guys to pay attention is this portion right here, okay? You notice that you're paying very little in principal towards the beginning part of your mortgage life cycle, and vast majority of what you're actually paying in the beginning is the interest. So out of that $1,000, and I'm just giving you an illustration, this may not be accurate, out of the $1,000, about $800 initially is going to go towards interest, and about $200 is going to go towards principal. And this is on a 30-year amortized loan. So what that basically means is that towards the earlier part of your mortgage, the banks are profiting off of your mortgage. They're getting their profit, they're pocketing their money first until right around about 8 to 10 year mark. This is when you start to go in and start paying your portion, the principal portion first. Now, here's the issue when it comes to the 30-year mortgage, and here's something that the banks aren't telling you, and all they tell you is, hey, listen, you're saving money, you're getting a better interest rate, your monthly payment's gonna go down, but this is something that your banks aren't telling you if you choose to go get a refinance loan, or if you choose to refinance because your bank's trying to convince you that you're actually saving money. But I'm gonna tell you guys right now that you're actually not saving much money at all. So let's say, banker or whoever calls you and says, hey, Mr. and Mrs. Borrower, you've been paying this mortgage for the last 8 to 10 years. You've been doing really great. Congratulations. Hey, listen, we have this sweet promotional interest rate that we can save you money. Come back in. Let's go and refinance your loan. Instead of paying $1,000, let's get you to start paying, $800 instead. Okay? And of course, a lot of people, because they don't know much, they'll say, hey, that's $200 less that I got to pay every month. And that sounds amazing. This is great. And they come back in and they go get refinanced. Now, here's the issue with this. When you go and refinance, do you get to continue the progress and capture all this principal? No. What happens is when you refinance, you have to start all over, back into square one, okay? And you're back into this zone, this period where you have to pay more in interest than actually paying the principal. So what happens is a lot of Americans, and this is true internationally, people refinance every 8 to 10 years, and they perpetually get stuck in the zone where all they do is just refinance over and over. They never make it to this part where they're building up equity and actually paying off their house. This is one of the big reasons why I believe that a lot of people are in debt, because they keep getting convinced, right, by the banks and mortgage lenders and brokers that they're saving money by refinancing, lowering the monthly payment, which actually in the long run, you're never getting to pay the principal portion, okay? The banks never want you to go into this zone, because as soon as you go into the principal payoff zone, okay, they're not making money off of you. They don't have the ability to charge you interest. So The banks don't want you to get to this zone right here where you're paying a bulk of your payment towards principal. So next time you go get a loan or you're looking to shop, you're looking to get a refinance, do reconsider. And I know a lot of you guys are considering getting a refinance. I'm going to show you guys a better option. I'm going to show you guys a better alternative. Instead of refinancing to save quote unquote money, my brother and I developed a strategy where we're going to show you guys how to pay off your mortgage within 5 to 7 years on average without making any more money, without cutting back on expenses, without ever refinancing with this one little strategy. So I'm going to go ahead and actually put that video right here so that you guys can go and click on it, watch that video, and learn to pay off your mortgage within 5 to 7 years on average, and literally bypass the need to be in this trap, right? Don't fall into the trap that the banks and the mortgage brokers are setting up for. All they care is that they want you to stay in this zone right here, where bulk of your monthly payment is going towards interest, not principal. So guys, if you felt like this video was helpful in any way, go and make sure to subscribe to this channel and be sure to hit the like button and as well as hit the bell icon so they get notified for our future videos. And of course, check out the video on how to pay off your mortgage in 5 to 7 years. And we're going to show you guys some really cool tricks. It's not magic, it's just math. Okay, and go and definitely check out that video. Cool? I'll see you guys in the next video.